Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, national underwriter for Old Capital. And joining me today would typically be, again, Michael Becker, but he is tied up doing due diligence on another acquisition. So in the podcast, we have Hans Box.
Hey, Paul.
Hans also with Old Capital down in the Austin office for Old Capital. So Hans, thanks for hanging out with us. We appreciate what you're doing down in Austin.
Thanks for having me.
So in the podcast today, we have a friend of ours that we closed a transaction. We closed a couple transactions. We're going to talk a little bit about that. But he lives in the Austin, San Antonio, San Marcos area, and we're going to talk a little bit about, what's going on in the central market of Texas. And, Dallas is a big metropolitan area. Houston, I guess, would be underwater right now. Hans, what do you think?
At least it used to be. It's probably a little muddy still.
So just the generator of a large amount of economic activity in Texas is central Texas, all the way from Dallas on 35, past Waco, through Austin, through San Antonio. And between Austin and San Antonio is San Marcos. And so we're going to talk a little bit about his acquisition in San Marcos that he did. Also, we're going to talk a little bit about an acquisition that he did out in Arizona, too, I would imagine. So we're going to talk a little bit about what's going on. So in the podcast today, we have our buddy, Selvam. Selvam, how are you?
Very well, thank you.
So I'm going to kick it over to Hans, and let's get it going, Hans.
All right. Well, Selvam, we've worked together for quite a while now, and just want to let the audience kind of know your background and what made you decide to get out of corporate America, and what were you doing there, and what made you decide to move into multifamily, and just talk to us about that story.
Firstly, thank you for having me here, Paul and Hans. Yes, it's been a while since we've been working together, and to briefly touch base on what I've been doing and for the past few years, and then how I got into real estate. Originally, I grew up in Australia, and my background is engineering and management from Australian schools, and then I moved here about 20 years ago. And then one thing that's always pertained in our family is single-family residences. Our parents always bought, but never sold. So that was like a thing and every time we moved, we always retained our single-family homes, and we always rented them out. And that kind of grew into me as I was growing up. Being from a technical background, I was in the consulting company as a program manager for a large tech company, and I was managing large global infrastructure projects for many years. And then about 10 years or so ago, I did a stint at a multifamily real estate firm. And and my interest grew there, and I always was fond of real estate being our family homes were never sold. So that kindled my interest, and that's how I fell into multifamily.
What kind of capacity were you in that business?
So I set up the entire infrastructure for this multifamily firm, and they are currently they're actually called McKinley Associates, based out of Michigan. They are close to about $5 billion in assets now. At that point, they were like about $2.5–3 billion when I was there. Wow. Over 10 years ago. So that's where I got my foothold, my interest, and so forth in multifamily.
That's great.
Great. So I believe you got into multifamily full-time about 1.5 years, 2 years ago?
Over 2 years ago.
So how did you decide to take that step and quit your job, which is, safe and getting that monthly check to going into the Wild West?
The interest was there, and I'd done large infrastructure projects around the world, and managing a project is same as anywhere. So the interest was always there, and I had to take a step and out of the corporate office and being out in the open, driving to buildings, all that kind of kindled my interest. And so either I had to, midlife crisis maybe, I jumped right into it.
What did your wife say about that? I mean,
she shook her head, and she still does, especially when I'm on the road.
That's great.
Yeah, but I bet you're proving her correct now, and we'll kind of get into some of those properties you own.
Well, she's happy to see the deals come through, yes.
That's great. So how many deals are you involved with now with your group?
Totally as a group with our equity partners in California, Arizona, and Texas. We're close to about 1,000 doors now.
Okay, that's great. And that's across how many properties?
I would say that's across about 12 properties.
Okay. Okay. And I know a number of those are smaller deals out west.
Correct.
And the first deal we worked on together, I believe, was called Sage Luxury Apartment Homes.
Correct.
And that was an interesting deal. It's in Mesa, Arizona.
Correct.
And you own 86 units, if I recall correctly. And it's a condo, a fractured condo. Could you kind of describe that deal to the audience and kind of inform them what a fractured condo deal is?
A fractured condo is when the entire condo is not owned by one single owner. A single owner owns a majority or a portion of the condo. And so, in other words, it's fractured. So out of this 96 units, we owned 86 units out of 96 units. And we were the majority owner, but there were still another 10 units being held by other individual owners in the condominium. Being the majority owner, we had the HOA declarant rights as well. So that was an interest for us so that we can maintain the entire complex like the way we wanted to. So that was another added attraction as part of that condo deal.
Right.
Overall, eventually we may buy out the remaining condo owners. We may not, but we own majority of it. So because of that, again, through All Capital's help, we were able to put together a Freddie Mac deal because it was over 90%, close to 90% owned. And Freddie Mac was even was the agency lender for us.
Tell me a little bit more about, the control of the condo association. You guys became the majority owner. Would you think you would have a difficult time if you were just buying, instead of 90% of the property, you were buying 49% of the property? How difficult? Now, you've done another fractured condo transaction before. Was that a difficult transaction to do? Did you guys own the majority of the condos in that one too?
Yes, we did. We bought another condo deal. That was actually a much lower percentage. We owned 78 out of a 250 unit condo complex, also in Phoenix, Arizona.
Tell me about that one, because
Right.
I think that's something to talk about too, because a lot of people, they see some of these fractured condos. So, again, you don't own the majority of the condominiums. You don't have control over the HOA, and they still want to try to buy them. So I want to kind of figure out what's the advantage of trying to buy that and how difficult was it to get done?
Condo deals typically are tough deals to do. We kind of learned it the hard way from the first one, but then since we learned, we got a little comfortable with that. But when you don't hold the HOA declarant rights, you don't control the expenses or how the entire complex is being run. You have a say, but not as much as you would if you held the declarant rights. And depending on what the declarant rights state in each HOA complex, the lenders look at that closely, and some of the lenders do not like it, and it's tough to do a condo deal. Now, having said that, if you own about 90%, it gets better because just like I had mentioned earlier, Freddie Mac liked it, even though it's a broken condo, they like to do deals where you own a majority. When you don't, again, depending on the declarant rights, you're limited to what you have as to a say in it. The previous one, 78 units out of 250, we held 29%. And the cutoff was 25% or above would hold the declarant rights. But then the declarant rights also had a clause in there saying that any single owner above 25% would always keep trying to sell certain portions of their assets they hold. So although we hold 29%, they expect us to over a year sell at least one or two. So there's always some clause in these HOA regulations and declarant rights that you have to have closely looked at. And typically you need a strong attorney who works with your lender's attorney to look at those. But it is a tough deal, but took us almost 6 months to close that, but we did it and we learned from it. So
that's why you probably went towards more of a full control type deal with the Mesa, Arizona deal.
Exactly.
Right.
So then our next one was 90%, so which really helped us, and it's only 10%. And the remaining actually owners in the HOA condominium complex like it because we bring in our controls, we bring in our changes, our improvements, and so it's been good overall because we try to have that so that we are able to bring the change to the whole complex.
Right. So you're operating that as a multifamily apartment, is that correct?
Correct. Correct.
Okay.
Correct.
Yeah. And then you have 10 units that are not owned by you, and you, I guess, are kind of just work with those other 10 owners to make sure everybody's happy.
Oh yeah. Oh yeah.
What typically is that those 10 owners that are independent of Selvum and his group become like lobsters in a pot of water. You turn it on real slowly, and then you increase it. And that's what you're doing with hopefully HOA or condominium association dues, to force them to sell that complex over to you. So you start off at $300 or $400 in community fees, and that becomes $450, $500, and all of a sudden you hear, Uncle Selvum, please buy my unit because it's just gotten too big. Is that the game plan, or are you just still pretty good at keeping the tenants in there pretty happy?
Not really. I mean, if somebody is looking to sell, we're more than happy to buy them out and bring them along on board with our assets. But because we hold 90%, we're more than comfortable. It's almost a clean multifam deal because we own 90%. Agency loans are okay. So even if we were to sell it, the new buyers would be should be able to get an agency loan. So it works out pretty well. But if any of the owners want to sell, we're more than happy to buy them out as well.
Yeah, if you were able to buy them out, the value of the property would increase because it'd be a cleaner multifamily deal.
Exactly.
And they would get better debt, and it's overall easier to understand for a lot of owners.
But Freddie Mac wouldn't make the loan on the remaining 10, so you'd have to go out and find a community bank or so that would help Selvum and his group acquire those units that the seller of one of those units wanted to sell to them.
That's right. And then maybe refinance later into something else.
Right.
Or sell it as a whole block.
Right.
Right. That would be the ideal scenario. If it happens, fantastic. But we're sitting rosy right now.
Sure.
And actually, in some ways, the remaining 10 don't want to sell because we brought in so many improvements now. So it's a catch-22.
You dug yourself a hole. That's all.
Kind of.
You're being too nice.
I don't know.
So I think the long and short of that is those kind of deals can really have a lot of value add and a lot of opportunity, but there's also a lot of difficulty and things you have to be careful of before you acquire a deal like that.
Right.
Okay, so let's kind of move to Texas, which is where we are and where we live. And you live in Austin, right? Correct? So the last deal you purchased was a deal here where we are located today in San Marcos, Texas. So where is San Marcos in relation to San Antonio and Austin?
Well, San Marcos is about 20 minutes south of Austin and about 30 minutes north of San Antonio. It's right on the I-35 corridor. So if you want to compare Austin and San Antonio, it would be more like Dallas and Fort Worth, if you want to call it. And the growth in this sector has been tremendous, as most people would know. Austin is expanding out further south, and San Antonio is expanding out further north. So they're all compressing. And a typical comparison would be Dallas and Fort Worth is what I would think. Yeah.
Yes, I've actually seen articles rather recently published that Dallas, direct comparison, Dallas-Fort Worth,
did you?
Yes,
Okay.
to Austin and San Antonio, that this corridor, the 75-mile corridor between Austin and San Antonio is filling in, just like the I-30 corridor and filled in Dallas-Fort Worth, 30 years ago maybe. But
Right.
It's a little bit longer, but it is a hot area with low supply and a lot of competition. So you probably didn't find just a ton of deals to buy, did you? It was
Actually,
competitive.
no. Yeah. We still are looking in the area. We do not see a single building for sale.
Sure.
One thing to add about San Marcos, in the last 5 years, I think the last 3 years out of the 5 years, they have been the top growing city in the United States, not just Texas, in the United States.
Yeah, what I like about San Marcos, besides that it's the corridor between Minneapolis to Mexico, is that Texas State of San Marcos is here, and it's probably one of the fastest growing universities in the country. That's right in the front door of next to your property.
Right.
But also, too, is that they have this huge outlet mall that if you go there, you're going to see nothing but Mexican plates in the parking lot. And everybody who, some of the people that have of affluence out of Mexico come right up 35, I guess, out of Monterey. They stop in to San Marcos, fill their Suburbans full of stuff, and bring it right back down to Mexico. So I can't tell you how many Mexican plates that I've seen in the San Marcos area. But this is a tremendous growth area, so I do feel that quite a bit. So is that the reason why you liked San Marcos?
Absolutely. Austin, it's kind of getting a little too hot, red hot, as you know, for a while, and it's still hot.
Yeah, you might as well invest in San Francisco.
Right. It's all relative, right? But yeah, San Marcos was strong, as you mentioned. Texas State's got close to 40,000 students, which is 2 miles down the road from our property. The Outlet Malls is just one exit north of where our property is, Park Hill. And just in San Marcos, there's close to about 13,000 non-manufacturing jobs and about 3,500 manufacturing jobs just in San Marcos, and it's growing. And another about 1,000 yards from us is the Amazon Distribution Center, where it's 1,000 jobs. Down the street from us, we have another 1,000 jobs, is the Texas Medical Center. So we're jobs everywhere, and was a hot location for us.
Selvin knows this area.
Yeah. And I'll add that you can commute from San Marcos to San Antonio or Austin rather easily.
Right. It's almost becoming a suburb of Austin now.
Yes, it's very easy. And in fact, a lot of people want to live south of Austin in the Buda, Kyle, San Marcos area because they can't afford Austin, as Paul just alluded to. So we touched on the supply issue and the fact that it's highly competitive and your experience, but you hadn't bought thousands of units when you purchased this last property. So how did you find the deal and how did you get brokers to take notice? And just talk us through how you located the deal and got it under contract.
Your first deal for us in Texas, of course, was hard. You network, you build relationship with brokers, and, relationships, just like with Old Capital, matter. If you don't do a deal today, you'd always do a deal another day. So we always maintain the relationships and contacts with brokers. And then one thing we did was this particular one. Obviously, Old Capital was able to help us out with this in so many ways. But starting with planning the deal early was a big help for us. And where Old Capital was able to help us or assist us was they were able to underwrite this and take it to Fannie Mae and have it pre-approved even before we went into contract.
Yeah, if I recall, you didn't have a financing contingency.
Correct, exactly. So that was one of our, because we had it pre-approved through Fannie Mae, we could confidently go in with really good terms.
What does that mean, no financing contingency, Hans?
Well, that basically means that Selvam, once his earnest money went into the deal, Selvam could not drop out of the deal and get his earnest money back due to financing reasons. So we basically had already secured financing from our Fannie Mae DUS lender for Selvam before the due diligence period was totally up. And we were able to do that because of the particular DUS lenders that we work with, our close relationship, and their methodology of going through their loan committee.
That's great. So tell us about this deal.
So I guess, Selvam, let's talk real quick. What other terms, how did you get the deal? What were the terms? There's no financing contingency. You had money that went hard, and I believe...
Right. Typically, sellers like to see, full control of your equity. And so we had ready equity, first of all. We had to make sure that we had the deal underwritten and pre-approved by Fannie Mae so that we could go in confidently without finance contingency. We had a short feasibility period, and we had significant earnest money down. And we did put down some hard money as well, because this was a good deal. We had it pre-approved, no finance contingency. We liked the deal, and we went after it.
Got it.
And when you do all of this, the sellers and the brokers see that you're serious, and they want to do the deal with you. And so that really worked out for us.
Yeah, and I think it was down to you and one other buyer, if I don't recall correctly, right? And they actually bid more than you, but you got the deal.
Exactly. And actually, Old Capital did help us out. You had a prior relationship with the seller, and you were able to talk to the seller and put us two together, saying that we were good for our deal and that they should strongly consider us, which the seller did, which we all appreciate, which kind of closed the deal, actually.
Yeah, and I would just add to that, and thank you for that comment, Selvam, is that if you're working, not with Old Capital, but if you're working with a large multifamily banker throughout the United States, I would think that they do have relationships. And so if it comes in a competitive situation, find out if they have done a loan for that seller in the past, find out if they know the seller. Maybe you can kind of work through the the back channels, just kind of like what Hans had done. The broker who represents the seller is one channel, but there's always good to have kind of the back channel and kind of, check what's going on, what's the truth and what's not the truth in some of these deals. And so I think Hans, in this case, was instrumental in getting a confidence level to the seller that Selvam and his partners were the real deal, because these deals are, I wouldn't say far and few between, but I will say they were far and few between, especially on good properties that have a lot of interest. And so they don't want to blow it with somebody that doesn't know what they're doing. So working through the back channel, Hans definitely helped the group get the transaction. So great job, Hans.
Well, thank you, Paul. Maybe it was just luck that I knew the guy, but I've been in the industry a little while. This deal was structured a little differently as well. You didn't just have one group that bought it. You actually had a 1031,
Correct.
And what's
correct.
called a TIC structure. And maybe you could talk the audience through that structure just briefly, and we can discuss how the financing worked for that.
Typically, we do our deals as a closed-ended project-specific fund with the GPLP structure is what we like. And we do it with a private place PPM and a private placement with the investors. Now, this particular large investor had come halfway through our, while the deal was in progress, they wanted to participate with us. And they had a 1031 exchange that they had to use within a short time period, within the allocated time period. So once we had to bring them on board, then we had to have two LLCs as tenants in common structure. Again, this is where Old Capital and our dust lender, Darty, came into play. They were nimble enough to do the whole structural change and have it again approved and moved it forward without hesitation, which really helped us out. Although there were major changes, they were able to do it and move this forward. And in fact, we closed this deal within 60 days, even with all these changes. So the entire deal, a Fannie Mae deal, was closed under 60 days, which was great for us, the seller, and of course, everyone else.
Yeah, I think that's a testament to our dust lender in this deal. There was quite a few changes, and I believe that TIC structure changed at least once, if not two or three times,
Correct.
Close to closing. So they had to re-underwrite the guarantors and the structure. And obviously, even though the financing had been approved overall, there's still a lot of nuances that have to be taken care of before a deal can close. And when you have the clock ticking, you want a lender on your side that is flexible and one guy you can call that can take care of it. And I believe, at this point, you've gone on first name basis with our friend there, and we're able to get it done. So
Indeed.
So let's talk about the loan itself. High level, what were your loan terms? Let's just talk high level. It was a 168 unit deal here in San Marcos, built in 2001. And let's talk through the loan terms and what you were able to obtain.
Yeah, so we wanted to have a fixed loan term given to minimize the risk associated with any fluctuations there. So we did a 12-year fixed. It was agency loan at Fannie Mae at 4.25% with 3 years IO. And
What is IO?
interest only.
Okay, so you get 3 years interest only, and then in the fourth year, it starts amortizing principal interest payments.
Correct.
Okay.
Correct. And we were able to do a LTV for 80-20 LTV. So that was a really, really good.
So 80% loan to total cost.
Correct.
And were you able to get any rehab funds?
Yes, actually, we were able to get about $300,000 baked into the loan proceeds for rehab funds.
Okay.
So that, in fact, brought our LTV below 80, if you want to call it.
Sure.
All right, that's Hans. He's all serious. Let's talk about the deal itself. Stabilized, value added. Tell me a little bit about the property. I mean, again, the property's not very old, 16 years old. Pretty good condition.
Oh, it's an excellent condition. And the value add we are trying to bring to it is, as you know, it's a total high growth area with a nice property and amenities. We knew we could push rents up. So the value add we are bringing is we are upgrading the pool area with new pool furniture, pergolas, an outdoor kitchen. That's in the outside exterior. And we're also doing the landscaping to bring about a little bit of color and light to the area. Now, interiors, we're doing two sets of upgrades, either a black appliance upgrade or a platinum upgrade. With the platinum upgrade, we're able to get about $85 up in rent. And with platinum, we are pushing rents up to about $125. The platinum, of course, with the whole package, including granite countertops, we're able to push up to about 125 in rents.
Wow.
So the value add is tremendous, and this was left open for us to take advantage of. The property is not very old, but it's in excellent shape. Just minor lifting here, and with the interior upgrades, it's looking really good.
Great. So how many upgrades have you done so far? Are you starting to rent these out now at the new levels?
Right. We've just started. We've done I think they've done about 4 now. So we're moving forward and doing the remaining. We plan to do about 30 this year, the next 12 months, I should say, and then move on from there.
Okay. So basically your goal here is to increase the NOI by doing upgrades, increasing rents, and obviously managing the expenses, possibly getting a supplemental loan at some point in the future if you need to, but you're holding this for cash flow.
Exactly.
Okay.
Exactly.
Okay. And we talked a little bit about team, but I believe, you don't manage this day to day yourself. You hired a third-party management company. Am I correct?
Right. In California and Arizona, where we have a critical mass, a lot more deals going, we self-manage. And we thought until we have a critical mass in Texas, it's ideal to have it third-party managed. And so we went through a third-party management company.
How did you choose them?
Again, we got multiple recommendations through referrals, and we did our own due diligence in terms of how they are flexible. The management team is working with our owners like us, and how they perform upgrades, how they did their bidding process for vendors, or the overall experience of their team. We looked at the fee structure, and then putting a blend together of how comfortable we felt with all of these items, then we were able to narrow down on our property management company. And one other thing also that immensely helped was we retained almost all the staff that were at the property.
So you kept that knowledge.
Yes, exactly. So keeping that.
How critical is that to keep the staff? From the last group that owned it to you, did you learn a lot more than you would have if you brought a brand new crew on?
Right. I mean, with a brand new crew, you can do it. I mean, there's a learning curve there. So the staff would have to learn the property, intimate knowledge. Like the maintenance supervisor has been there even from the previous seller to the one we bought from. So he's been there at the property for the last 3 sellers, apparently.
Wow.
So everybody's liked him. He's always retained there. He knows the property in and out. He lives on the premises. So he knows every nook and cranny, and even when he's off duty, he's fixing things as he walks through. In fact, while we did our due diligence, when we did our own inspections, the inspectors actually came back saying for the age of the property, they've not seen a clean property as this one. So, which was pretty interesting.
Well, that's great.
So the staff remaining there is a statement to how well the property was being run.
Talking about clean properties, Hans, do you remember what the replacement reserves were on this property?
I believe they might be $250 a door on these that were required.
Does that sound about right?
$275, yeah.
And I think that's something to understand. Some of these older property, we throw in as a place saver, $250 or $275, but typically on the older properties that were built in the 60s, 70s, or 60s or 70s at least, look for $300, $350, maybe $375, maybe $400 a door annually for replacement reserves. So that's the money that's going to have to be set aside on an annual basis to make sure that you have enough money in your savings account to pay for any capital improvements to the property. So this property, the seller kept that property in pretty good condition. The previous sellers to them kept it in pretty good condition. And now the asset has been handed to you. And so the engineer determined that $250 was pretty good. So
right,
that's
exactly.
A clean property.
Exactly. That's very clean. And I would add to what Paul's saying, even though the lender may place replacement reserves on in your loan at $275 or $250 or $300 or something like that, but you look at the property and decide that it may need more, be sure you underwrite to what you truly think the property will need and not just what the lender forces upon you. That's important. So you bought this deal back in late June, end of
Correct.
June, if I'm correct.
Right.
And so what have you been doing since then? Been looking for another deal? And kind of what is your next plan? What are you planning to do?
We are looking for deals all the way from San Antonio up till Dallas. So we're looking for other multifamily deals. Our sweet spot is under $20 million and over 168 or 170 units.
Okay.
around 200, 225 units is our ideal sweet spot, and under 20 million. The reason we try to stay below 20 million, just like with Park Hill, was we try to stay away from the REITs and the institutions who are big players who have a lot more cash to play with.
Sure.
And we as a private group, we try to stay under that. But we do look at deals slightly larger than that. If it's a great deal, with the numbers look great, we do look at larger deals above that. But typically, this is where we try to stay. So we are looking. Any properties out there? We are ready.
I-35 corridor, San Antonio to Dallas is kind of where you're looking.
That's what we're looking for.
Okay.
Tell me a little bit about the frustration when you first decided to turn on the light switch in the room that you wanted to become a multifamily owner. How many tires did you kick on the cars before you actually bought one?
Whoa, I would say hundreds.
Yeah.
Hundreds and hundreds. And we did not want to chase deals just for the sake of doing a deal.
Yep.
We knew the kind of deal we wanted to do. Being a new player in this state, it was a little difficult. But having done deals in the other states, we knew what we were looking for. But it did take a fair bit of time. But eventually we were able to get the right deal that was, I should say, perfect for us. Again, was 168 units, 2001 build, very clean, great proceeds through our lending from Doherty, and everything worked out well. So
that's great. What do you know today that you didn't know before?
It's a lot tougher than you can imagine, but it eventually happens.
Perseverance, right?
Perseverance, exactly.
I think that's important for everyone to note. And don't chase deals. Go where you're comfortable.
Right.
Any additional insights that you could share with people that are now in your position, they say 18 months ago, that besides the perseverance, putting together your team is important?
Exactly. Have your team in place, have your lending in place. And of course, Old Capital was able to hold our hand all the way through to the deal, so which really helped us. And then, of course, make sure you have your relationships with brokers, your attorneys, your CPAs, right through. Once you have your team in place, things get easier. It'll take a while to happen, but once you have that in place, it gets a lot easier.
Tell me a little bit more about your capital. Is this friends and family?
It's typically friends and family, close friends and family who invest with us.
Would you think about maybe if somebody wanted to get to know you a little bit, would you think about opening that up a little bit possibly? Sure.
We do have friends and family who bring in other extended friends and family. So definitely, just like we mentioned this in a previous deal, there was a 1031 exchange investor who was brought in through another friend. And it was a large investor, and we got to know them, and we did the deal with them.
That's great. Hans, anything more to add?
No, I think people can take some education away from this, from what Selvam's done, and I think it's his perseverance. I've been, I'm working with him for a year and a half now, and he is looking at a lot of deals. In fact, this week I think we've looked at 3, and that was starting on Tuesday, and today's Thursday. So who knows? We might look at 3 or 4 more tomorrow. So he has looked at a lot of deals, and I think that's key, is to comb the market, get to know people, build your team, and be patient.
What I like about Selvam is that he's always positive. There's a positive attitude that comes with Selvam. He doesn't get down on any one deal. He's looked at a couple of deals. He's made LOIs. He's been in best and final a couple of times, and we've kind of seen that he was not awarded the deal, but he lets the rain fall off of his coat and just continues to go to the next deal. I think that's an important point in multifamily when you decide to turn on the light switch and then you're ready to go forward, is that you got to keep a positive attitude, is that you're going to get rejected. I mean, it is a little bit like trying to become a movie star out in Hollywood. There's a lot of pretty faces out there, but you have a lot of talent. Just stay the course. You're talented. Move on, get a deal, and start running with it. And I think now, have you found, since you've gotten this deal, if the broker started to open up to you and showed you some more transactions? How's that been?
Definitely, it's getting a lot easier to see other deals coming through, and brokers in the market know. They know when we look at deals, we are serious. They know when we go to contract, we will close. So they see the confidence in us, and we are serious buyers. So we are looking, and if there's a right deal, we go to contract, we will close.
That's great. Hans, anything more before we say goodbye?
I think that was a good summary.
Yeah, Selvam, you've done a great job. I'm very proud of you. You've executed your plan. Hopefully, we've made your wife happy that she hasn't decided to.
I'm still working on that.
Especially probably when you decided to write a non-refundable check for the earnest money. She was like, "Are you sure we're going to do this?"
Either that or she'll come after us, Paul, for recommending that.
I would certainly hope not. But Selvam, thanks for hanging out with us. If somebody wanted to get a hold of you, what is the best way of getting a hold of you?
Email and phone, selvams@aviciholdings.com.
One more time, because I don't think I heard that.
Selvams, SELVAMS, at Avici Holdings, AVICHI Holdings.com. Or I'll give you my direct phone, 203-952-8111.
That's great. Some great information. Selvam, thanks for coming on, hanging with us in the podcast. Hans, anything more to add?
No, that was a great summary by Selvam and what he's accomplished, and I think our listeners can take a lot of education away from that.
That's great. Some good information. Remember, if you find this information valuable, please go to the iTunes reviews of podcasts. We're always looking for a 5-star report and maybe some comments if you think it was valuable. Again, we appreciate listening, and if you want to get any more information on our 15-page white paper report on multifamily financing, go to the oldcapitalpodcast.com, and hit the button, download our 15-page white paper report about multifamily financing and how to put these transactions together. So we appreciate everybody listening today. Selvam, thank you very much. We appreciate it. Hans, thanks for hanging out with us. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.